Well, ESG stands for environmental, social, and governance. In short, ESG investing is in effect a woke filter. Hi, I'm Neil McIver of McIver Capital Management at Canaccord Genuity. Today, folks, I'm going to be talking about the dangers of ESG investing. Now, if you don't know what ESG investing is, or you don't understand it, don't feel badly, as most people do not, including many people who are currently ESG investing. But first up, as I discuss this topic, please keep in mind that for the most part, all of us, including me, wish the world to be a good place and to make it better if we can. And to that end, over the last 250 years, it's worthwhile to keep in mind that the rise of our market-driven, merit-based democracy has led to the greatest advancement of the human condition in history. It's lifted hundreds of millions from poverty and serfdom. It's provided for the greatest advancement in science, technology, and personal freedom. By any measure, today we in the West are more equal, more ethical, and have more opportunity than at any time in history. So what is ESG investing? Well, ESG stands for environmental, social, and governance. And as a group of words or a phrase, they do not seem to have any meaning, and that, in fact, is appropriate. From an investment perspective, ESG investing is applying a layer of non-financial factors when analyzing the value and investment merits of a company and its stock. Specifically, it is a filter which companies are analyzed based upon their supposed impact on the climate, their policies towards diversity and inclusion, and finally, how their governance reflects their adherence to these directives, in addition to a long list of other related directives. In short, ESG investing is in effect a woke filter. Now, whether or not this filter is just one of the many filters that is layered on top of actual financial performance analysis, or the only filter applied and no actual financial performance metrics are analyzed, simply depends on how strident or extreme the ESG advocate or investor is. As you might guess, this type of investing creates some significant problems, and as you'll see, it also lacks a certain amount of common sense and intellectual honesty. Of the many intrinsic problems, I will just outline 4 with you today. The first 2 will help you understand the problems. The second 2 will highlight the specific dangers you need to watch out for. The first problem arises when you simply try to determine which company is ethical enough to be in the ESG club. What is considered to be an ESG company varies massively from one interpretation of the filter to the next interpretation of the filter. Virtually every investment dealer, bank, investment company, or professional association has their very own malleable interpretation of what constitutes ESG investing. If you're familiar with Eric Weinstein's 4-quadrant model, and if you're not, I would encourage you to look it up, you'll understand that corporations have virtually no true moral values and are instead rent seekers in the virtue signaling game. Accordingly, you will then understand why corporate interpretations of ESG investing are necessarily very malleable. Noisy lobby groups and nonprofit groups, on the other hand, usually have a very hardline interpretation of what an ESG investing is and will stop at nothing to force the adoption of their standards. But beyond these immutable facts, you can imagine yourself the difficulty in trying to select ESG standards and eligible companies. For instance, is an electric car manufacturer ethical and ESG? An electric car massively draws power down on electrical grids. Many of these grids are powered by coal or nuclear. The cars themselves are filled with plastic, and its battery is sourced from minerals that are often mined in ways that reportedly exploit or even kill children. So is that in bounds? I don't know. Recently, Standard & Poor's removed Tesla from its ESG 500 index, while oil giant Exxon remained. Do you agree with that, or do you disagree? With some filters trying to prevent even animals being eaten, virtually any social cause you could imagine could be part of an ESG filter. Quite simply, there is no standard ESG filter because creating a common standard is both impossible to agree upon from one person to the next and from one organization to the next. And as we shall see, it's also bad for business. I'll shortly talk about how ESG and its agenda is increasingly impacting corporations. Now, the second problem with ESG investing arises when ESG advocates or ESG investors try to determine the relative weight or importance of the ESG score. Most financial institutions have created a scoring system to evaluate a company's adherence to ESG values and dictates. As you might imagine, companies involved in petroleum, natural gas, metals and mining, alcohol, confectionery, etc., all score very badly. But not only do scoring systems and filters vary widely from one organization to another, there's also a significant difference between institutions on how these filters are applied in the process of stock selection. Should the ESG score comprise 100% of the information analyzed to select a stock? Should it be 50%? Or should it be 0? A great many people argue that it should be the only filter applied, or 100%. Okay, so let's look at what a 100% ESG stock analysis would look like. Let's imagine for a moment that a public company decides only to hire people based solely upon whom they identify with or their skin color, and not based upon their merit, abilities, and experience as they always have done previously. And then that group decide that the board of directors and senior management need to be selected and chosen based upon these same ESG parameters, and again, not merit-based. Let's imagine that this new management group rules that it will only distribute its products to customers willing to walk or cycle to its manufacturing locations to pick up their products. And those customers must be willing to sign a pledge never to transport their products by an internal combustion engine. Compensation becomes based not upon productivity, experience, performance, or the level of responsibility of the employee, rather strictly upon the historical injustice suffered by the group that the employee identifies with. Additionally, the new management group decides to turn 50% of any profits over to the United Nations. Imagine that. Their ESG score would be top of the heap, best ever. They would likely be on the front page of both The Economist and Newsweek. But ask yourself, does that make any intellectual or economic sense at all? Would you buy that stock into your portfolio? Where does that sit on the market-driven, merit-based continuum, which has created the wealth, the health, and the prosperity that we all enjoy today? The third problem should concern you more than number one and number two. And that's a significant inherent volatility and risk of adhering to an ESG agenda or mandate. As I've spoken about many times before, positive correlation in a portfolio is a negative thing. And this occurs when we have a portfolio of similar positions, all of which have the tendency to rise and fall at the same time based upon the same economic inputs. A typical example of this would be a portfolio of Canadian resource stocks. The resulting volatility decreases the long-term performance because mathematically, losses disproportionately negatively impact long-term performance. If you lose 50% in a portfolio, then you need to gain 100 simply to get back to zero. This is exactly why we at McIver Capital Management go a long way to specifically build negatively correlated portfolios. Now, as we have seen, there's a large disparity between various ESG filters, but they all do essentially the exact same thing. They artificially restrict the universe of available positions that a potential portfolio could own, and the stocks which typically are able to pass through these filters are all very similar to one another. And the subsequent result of this is that all of the potential positions for an ESG portfolio have a tendency to be positively correlated to one another. We know that this will increase the volatility and it'll decrease the long-term performance. Now let's look at a very real-world example of this mathematical reality. This is likely the most well-known and popular of the many actively traded ETFs or exchange-traded funds, which operate a significant ESG filter. Holding highly concentrated and heavily ESG filtered positions, this family of ETFs was the darling of the investment world just as COVID washed over the world, with this particular one being the flagship. It was the undisputed champion of investment genius. In short, it was discussed as the very future of investing, until it wasn't. When the COVID checks began to drying up and the speculation mania began to die down, this massively popular ETF began to fall. This flagship ETF has now lost an amazing 70% of its value since last year, and more than 50% just since January alone. If you had put in $10 million into this rockstar managed ETF in January of 2021, you would have lost $7 million by June of 2022. Remember, folks, if you lose 50%, you need to gain 100 to get back to zero. So this means that even if you're able to find a 10% annual rate of return, it will take 7 years just simply to get back to zero. Now, a loss of 70% like this will take more than 12 years to make back. And again, that's only if you're able to find a very difficult and steady 10% annualized rate of return. This is a long time to wait just simply to get a 0% rate of return. These losses are devastating. Now, unbelievably, this exact same company just launched a new ETF just a few months ago. This one is based solely, meaning 100% on ESG metrics and 0% on financial metrics, and it's called the Transparency ETF. Now, this virtue signaling ETF has already lost a whopping 37% of its value. The crazy thing is, the more stringent the ESG rules, the more positive correlations there are between the individual positions in the portfolio, and therefore, the more concentrated the portfolio is, which results in more volatility. And typically, more volatility results in poorer long-term performance. So effectively, the more stringent the ESG agenda or mandate is, the greater the likelihood of poorer long-term performance. Now, that's just simply the math, folks. Now, a few minutes ago, I spoke about the great variance in how corporations or organizations interpret ESG investing and filters. And in a moment, you'll understand why this is. Now, in order to avoid the type of volatility in those ESG ETFs that I just went through, we see organizations such as Standard & Poor's kicking Tesla out of its ESG index while adding in Exxon. They are likely trying to add balance and negative correlation to the index, which makes absolute sense from an investment perspective. But then, are they really ESG investing? I think the hypocrisy is plain for most to see. The fourth problem with ESG investing relates to the role and purpose of those in the investment industry. And we're certainly not the only ones in the investment industry to point out the hypocrisy, intellectual dishonesty, and the risks. The greatest fear of the anti-business crowd is infinite prosperity and growth. This crowd has been all over the promotion of ESG investing from its very inception, because they know that by making ESG investing a social imperative for corporations and investors alike, that they can curtail infinite prosperity and growth, and they can exert much more control over business and the private sector. That social imperative of ESG has been so great that many banks and investment dealers have been accused of greenwashing. Now, greenwashing is effectively pretending that non-ESG investment funds and portfolios somehow represent ESG investing in order to make them more acceptable. Recently, one major European bank was even raided by 50 police officers based upon the accusation and suspicion that the bank had fraudulently claimed that half of their investment funds were ESG. Following this, the CEO of the investment division resigned. I think the question investors have to ask themselves is, what's in it for me? Because as soon as you are approached by an ESG investment advisor or told that the investment choices being provided to you by an institution are all ESG compliant, then that person or that organization is immediately telling you that they are not on the side of your infinite prosperity and growth and financial security, because they have already compromised the universe of potential investments down to a narrow set of investment choices which all fit inside of a social contract or political belief set. In short, they have an agenda with your capital. At McIver Capital Management, our perspective and philosophy is completely different. We work for you. It's not the other way around. We're not here to impose our values upon you. As fiduciaries, we have no other agenda. Our only agenda is you and your infinite prosperity, growth, and financial security. Thank you for watching. We at McIver Capital Management are always looking out for your best interest.